Hello there and welcome to Wednesday's Targets in Focus. I'm Doireann Mc Dermott and today I'm joined on the line by Sebastien Galy, Senior FX Strategist at Societe Generale in New York, to have a look at $3 pairs. Well, hello there Sebastien. Well, let's begin with the euro-dollar. Disappointing German business confidence data has raised expectations for a rate cut by the ECB. Now, how has the euro been affected by this recent data and where are you expecting to see a rate cut?
So we're basically before the German data, we were trading around 130 just above, and then on the release of that really disappointing data, we dipped below 129.60. Since then, we've retraced quite brutally on the expectations, of course, of that the ECB will actually cut its main target rate. But the issue with the ECB is that they can cut. I think it's slightly odd not to expect them to eventually cut. I think it's been flagged for such a long amount of time. The question is whether it's going to achieve much, and the answer is probably not that much, unfortunately. So it's boosting sentiment because the market is basically high in the opium perception that if central bank prints money, cuts interest rates, it therefore means that equities and risky assets will automatically rise. And it's the way the market has been trained, and it's reacting in this way. And the outcome of it is to see actually euro-dollar, jump higher on the back of negative news after a few minutes once the ECB rate cut is embedded, because probably assets rush back into Europe, equity markets rally and the likes. Now, we do expect that whether the ECB cuts a rate sooner or a little bit later, it doesn't really matter. They have no choice. We're going through a process of Japanification in Europe. We're doing the hard, the very, very hard slog in Europe. You're seeing the positive effects of this very, very tough love policy. In Greece, we've already, Greece seeing its primary surplus going positive, which is quite a significant achievement for that country after such a long amount of trouble. And so we're seeing a general improvement in some of the fundamentals. Not all of them, and unfortunately, the consequence of this is extremely low growth. Debt loads for sure remain highs, and low potential, basically, in terms of equity returns. Not necessarily equity returns based on local, local economic development. Based on global environments is maybe a good idea, but it's just a very subdued growth environment and a very difficult one, and it doesn't justify euro-dollar trading where it is. We do expect that it continues to head lower. Probably reaching 129 initially, and then basically drifting gently but firmly down to roughly 120 in about a year's time. That should be a combination of the negative euro story, which is going to be a permanent feature, and then on the other side, the dollar story we expect will, over 1 year improvement, will improve. So some of the data in the U.S. is coming out in a negative fashion right now, putting some downward pressure on the dollar. But actually far less than it used to be in the past. And I think people are recognizing that the U.S. as an asset is a better one over the longer term, and it's steadily, gently seeing a little bit of outperformance, and we expect that outperformance to continue over a 1 year's period.
And also, Sebastien, Australia consumer prices increased lower than expected in the very first quarter. This has actually raised expectations of a rate cut. Can you tell me a little bit about what we are currently witnessing with the Aussie dollar?
Sure. The data is slightly misleading in the sense that a lot of it is linked to fairly volatile measures such as food inflation and the likes. Aussie dollar has actually been trading in a wide range between about 106 top side to 102 on the bottom side when people get really depressed on risk, which is fairly close to where we are. One should remember also that commodities in general have suffered, particularly the agricultural sector, which is far less relevant for Australia. But the more broadly speaking, the commodity sector has not performed very well recently, and therefore Aussie dollar is taking a hit. Does it breach 102 level? The answer is it might want to. The most probable thing is that we're going to re-enter that 102, 106 range. Essentially, very wide range trading, which makes it quite interesting from from a speculative trading point of view. Longer term, the Aussie story is a bit more of a difficult one as China slows down. Infrastructural impulse also slows down. And also as the dollar rallies to some extent. So it might have a little very, very gentle downward trend over the long term, and mostly it's going to be traded, and we expect from a range trading point of view. So we're getting close to the bottom. It's probably you want to be more excited about Kiwi shorts given very heavy positioning in the market, and some people will be looking at these shorts as a global hedge for their total portfolios. So when I was on the buy side, we would take FX as a cheap way of hedging an equity book or a fixed income book, which was more risk oriented. And I think other people will continue to do so using the high degree of liquidity from the FX market. The one which is probably the most dangerous is a Kiwi yen, according to many metrics. So that's maybe one where people will focus. And if it blows up, then liquidity will suddenly disappear in that pair, creating more downward pressure. So it may be a good risk-off type of a hedge that you can get on that side. Of course, it's going to cost you money in any equity rally, but that's a point of the hedge.
And finally, Canadian retail sales increased 0.8%, which was more than anticipated. Well, Sebastien, what type of impact has this had on the dollar CAD?
Canadian dollar is having a mixed story, if you want. The retail was actually quite a positive surprise. I personally did not expect it, showing that the business cycle is a little bit more resilient than you would expect. Nonetheless, and I think that there's a tremendous amount and to some extent unjustified bearishness on the Canadian dollar, linked to the fundamental-based housing market and the likes. All these fundamentals tell you is that the growth in Canada is going to be more constrained over probably next year and a half because of that deleveraging which needs to happen at the level of the consumer and therefore very subdued growth, to put it mildly, at the level of the housing sector, which is something normal. At the same time, it's getting a hit also from oil, which is the inflation trade is somewhat correcting. But the real demand is what we haven't reached yet. So if you start to reach a level above 103.50, 104.50 to 105, there's very, very large amounts of money waiting to step back into the CAD. I think they felt very uncomfortable buying the CAD when everybody thought it was such a glorious thing. And they're waiting basically for that washout position to continue. Now, one should be aware that the market is already positioned bearishly for Canada. So if we do get really good data out of the U.S. or out of Canada, then these positions will be squeezed. So it's a slightly bearish trade. It's similar to if you would compare Spain to Germany, where we're trading a bit Canada like Spain versus the U.S. at this point in time, which, to my sense, is a little bit nonsensical, but it goes along the same type of thematic. So we're not at levels where the real buyers are going to step into the CAD, and 103.50 is probably the first levels, and going up to 105 where you're going to find the real heavy demand waiting to get into that market.
Well, viewers, that is all we have time for right now, but do make sure you stay tuned, and I will be back tomorrow for the Dukascopy press review. But for now, goodbye.